class, we will focus on the NPV calculation by considering the problem of taxation. So we will see how the NPV formula changes in the moment in which we are considering the taxation. Specifically, what is going to change is the cash flow, so the value, how we are going to calculate the cash. Let's see the differences between the two cases. If we have the NPV and we are calculating the NPV without including taxation, the formula is the basic formula and the simplest one. We can say that the cash flow equals the cash flow gross operating, which is also called EBITDA, or revenues minus cash costs. Let's move now to what changes in our cash flow in the moment in which we are doing the evaluation by considering the taxation. In this case, our cash flow in the moment in which we include taxes will be the cash flow net operating, where the cash flow net operating equals the cash flow gross operating, so basically what we used to do in the traditional formula, minus the taxes. How can we define the taxes? The taxes can be calculated in this way. We can say that the taxation equals the net profit multiplied by the tax rate. How can we calculate our net profit? The net profit can be defined as revenue minus cash costs minus depreciation and amortization multiplied by the tax rate. So in this way, we can calculate the net profit. Now, if we substitute this net profit within the general formula, we can identify the formula that we can use for calculating the cash flow net operating. So we will have that the cash flow net operating equals our cash flow gross operating, where our cash flow gross operating can be defined as revenues minus cash costs minus the taxes, that can be written in this way. You can see that taxes are defined by using this formula. So if we substitute this formula in the taxes, we will have minus revenues minus cash costs minus depreciation and amortization multiplied by the tax rate. So basically we have just substituted the cash flow gross operating with its formula and then the taxes with their formula. Now, if we solve the equation, we will have that the cash flow net operating equals the revenues minus the cash costs multiplied by 1 minus the tax rate plus the depreciation and amortization multiplied by the tax rate. So if we solve the equation, we have this value. So this is the formula that we can use in the moment in which we want to calculate the cash flow net operating, which is the cash flow in the moment in which we want to include the taxation. With respect to the traditional formula, so the simplest one, if you remember, the simplest formula is cash flow gross operating EBITDA also equal to revenues minus cash costs. So if we compare the traditional formula without the taxation with the formula that includes the taxation, we can see that the main difference lies in this term, which is the depreciation plus amortization multiplied by the tax rate. This component of the formula is defined as tax shield, to say that in the moment in which we are evaluating our investment, also including taxation, we are including depreciation and amortization. So the higher the value of the depreciation and the amortization, the higher the value of the cash that we are going to include. So basically, we will have always that if we calculate the cash flow net operating, because of the depreciation and amortization and because of the effect of this tax rate, we will have a value of the cash that is higher. So this is important because if we need to evaluate the investment, we will obtain a cash higher in the moment in which we adopt this second approach. Let's see the differences between the cash flow gross operating and the cash flow net operating with a really simple example, just to understand what changes between them. Assume that we have this simple data. We know that revenue, of course, keep in mind that we are adopting an incremental logic, so these are always deltas. So this is the incremental revenue, 100 euro. Then we have incremental cash costs, 90 euros, amortization and depreciation, 20 euros, and then we know that the tax rate is the 50%. We want to calculate the cash flow by using, without considering taxation, which means the cash flow gross operating, and the cash flow by including the taxes, which is the cash flow net operating. What happens in the moment in which we are using the simplest approach without the taxation? We just need to account for the difference between revenues and cash cost. If we look at the data that we have that the revenue is 100 euros minus cash cost 90. So we will have that the operating cash flow that we are able to generate because of our investment will be 10 euros. Stop. Let's move to the second case instead. In the moment in which we have the cash flow net operating, so we want to include the taxes in the calculation of our cash flow, we need to apply the other formula. So we need to consider the difference between the revenues and the cash costs. So we will have 100 euros minus 90 euros that multiplies 1 minus the tax rate. In this case we have 50, so it will just multiply 0.5 plus depreciation and amortization, 20, that multiplies the tax by the tax rate, 0.5. So we will have that this component is 5 plus 10. So we will have that the cash flow net operating, so calculating by including the taxes, as we already know, is higher because we have this tax shield. So because of the depreciation and amortization, and so because of the tax rate, we have a cash flow higher with respect to the one calculated gross operating with the traditional formula, let's say with the simplest formula. So this is a choice that we need to take in mind in the moment in which we need to decide how to approach our investment, because we can use both of them, but we need to take into account what changes in the moment in which we are adopting either the first one or the second one. We can say that in the moment in which we are using the cash flow net operating, this is the more precise, of course, because we are including the taxation that we have in the real world, but it takes more time, it is more complex, because we need the data on the tax rate and we need the data on the depreciation and the amortization. This formula is faster, so we need to calculate the cash flow faster, for sure we will go through this one, but it is also less precise because it does not take into account the taxation that instead we have in reality. So that's the main difference, but we need to be able to calculate both of them.